Welcome to Ekcel Academy's live session for CS Executive. Today we'll be looking at CMA subject, more specifically budgetary control. Just if someone is online, can you please confirm if my voice is audible? If it's audible, we will proceed further. Just a second, let me just open the chat in my phone so that okay, I think the audio is live, video is also live, I believe. Okay, so let's look at the budgetary control chapter. This is a chapter in CMA, and more specifically this is under the management accounting part. So before even we proceed towards the actual problems, let us look at what is a budget. A budget is a precise statement of financial and quantitative implications of the course of action that management has decided to follow in the immediate next period of time, says the textbook definition, that is from the ICSI material. So if you look at this, if you break down this definition, we'll be able to understand what exactly a budget means. They say a budget is a precise statement of financial and quantitative implications. We are mostly worried about this part, that is the financial part, of the course of action that management has decided to follow, in the immediate next period of time. So now what exactly do they mean by this? See, the first part is actually very easy. It's a precise statement of what type? Of financial in nature, and it mostly looks about financial implications. When exactly? In the next, or rather in the immediate next period. That means immediate next period means if you are in 2021-22, or rather now we are in 22-23, we will be looking at budget for the next immediate period, maybe 23 and 24. So we are not preparing budget for whatever has already happened. Obviously it doesn't make any sense, because for that we already have accounts which talks about history, whereas budget is like talking about future, like what exactly we wish to do, what is that we have in plan already, so that for the next immediate period, maybe 6 months or 1 year, what is that we have decided to do, and how do we do that, how do we generate revenue for whatever we have thought of. So all those things will be decided, or rather proposed in the budget, because we cannot decide anything about future, we can only propose. We can say that we may do this, we would like to do this, whether or not it will be possible or not, again it ultimately depends on how well the company executes it. So that is secondary. So if you look at this thing here, this is the budget image with respect to the union budget. I'm sure you know what exactly union budget is. Union budget is the budget presented by the union government. So generally they present in the month of Feb. Let's say in the calendar year 22, they presented the budget in Feb, that is on Feb 22 in the sense year 22. Now this budget is a proposal for the next financial year, in that case 22 and 23, because when the budget was presented, that is in Feb 22, we were in which financial year? 21 and 22, because as you may already be aware, a financial year starts on 1st of April and ends on 31st of March. So we were somewhere in Feb, so that means we were at the fag end of the financial year. So when they proposed the budget, proposed the budget for the next financial year. In our case, it was 22 and 23. Now if you look at this, it exactly tells us where the rupee is coming from and where the rupee will go to. For instance, this is of course a prediction or a proposal. They are assuming that in the year 22-23, because back then 22-23 was future. Now of course we are in 22-23. Rupee is coming from borrowings and other liabilities. How much of rupee is coming from that? 35%. That means how much of total revenue are we getting, or rather money are we getting from borrowings? 35%. Then how much of our proposed receipts are from non-tax revenue, 5%. Income tax is a huge chunk at 15%, and you can also include this under income tax because it's nothing but corporation tax, which is the tax which the companies pay, and union excise duties is 7%, GST is 16%, customs is 5%. All these are indirect taxes. All the three. Which three? Customs, GST, and excise. Then we have non-debt capital receipts, some negligible, 2%. This is where they are getting the money from. Now, where is it going to? So, of course, they will get the money and they will spend the money as well, no? So, now they are spending 4% on pensions. Other 9%, other expenditure 9%. Where is the major chunk going? Look at this, interest payments. So 20%, that is the biggest figure here. 20% is going towards interest, because if you look at this, where the rupee is coming from, the biggest chunk is actually coming from the borrowings and liabilities. If you are borrowing money, obviously your liability or rather your interest will also increase, right? So it's a natural thing for the interest to occupy a major chunk when it comes to the payments, because it also occupies a major chunk when it comes to the receipts. Then there is this state's share of taxes and duties. For example, the income tax or GST, whatever they collect, it goes to the central government. Then they will have to distribute it between the states. For example, if Karnataka is paying so much of GST and income tax, Karnataka will also get back that much of GST and income tax from the central government. So that is where it is going, because they are getting everything first of all, and then they will distribute it based on how much they are getting from each state. Then finance commission and other transfers, so that is some 10%. Then central sector schemes, 15%. They have to distribute to all these schemes and pensions and interest, and centrally sponsored schemes, some 9%, and subsidies 8%, defense 8%, things like that. So this is the budget which was proposed by the union government in this year, that is Feb 22. So this thing will happen at every level. For example, an individual will also think about the budget, because if let's say tomorrow you qualify as a company secretary and you start earning lakhs together, so let's say your first month salary is 1 lakh rupees. So even before you receive the salary, you would already be thinking about, where will I spend that money? What should I do with 1 lakh rupees? Maybe for 50,000 I'll buy a new expensive phone, or maybe I'll gift my parents something. Maybe I'll invest whatever I get, or maybe I'll buy something, buy some vehicle. See, in that case, you're already proposing to spend in various sectors. But if it's a salaried person, then the source will be very simple. You won't have these many sources like we have here, but instead you'll have only one source. That would be salaried income. If it's a business, maybe there might be multiple sources, but in certain cases, the receipts will be we won't have these many divisions. Basically, it will be just one source. But of course, this will always be more based on our needs and wants. Basically, that's all. So that is the thing. And if you look at this Union Budget 22-23 analysis, this is by PRS Legislative Research. It's an NGO which does these type of things. Now, if you read the word here, the word which they have used is proposes. The government proposes to spend 39,44,909 crore in 22-23. So that means, when did the government present the budget? In Feb 22. So in Feb 22, the government proposed to spend. That means we are assuming that during this financial year, that is 22-23, they are actually spending so much now. No, they also say, which is an increase of 4.6 over the revised estimate of 21-22. So last year they had spent 4.6% less compared to what they are proposing to spend this year. So that is the thing. Again, there are various other things. My intention was to draw your attention to this word, proposes. So it's just a proposal. It's a plan. Okay. Now, moving ahead. Now that we have understood what exactly a budget is, let us straight away get into the problems. Let us look at this problem, and then we'll see what exactly they are discussing or asking, and then we'll act accordingly. S produces and sells one product, P, for which the data are as follows. Selling price is 28 rupees. variable cost is 16 and fixed cost is 4 rupees. This is at present we have this data. The fixed costs are based on a budgeted production and sales level of 25,000 units for the next period. Again, what they're saying is this fixed cost, whatever it is based on what? Budgeted production. They have thought of some level of production which they think they will achieve, and also some level of sales. And that level is how much? 25,000 units for the next period. This period could be 1 year, 6 months, quarter, whatnot. Due to market changes, both the selling price and the variable cost are expected to increase above the budgeted level in the next period. Okay. So due to some changes in the market, they are bound to increase apparently. If the selling price and the variable cost per unit increase by 10% and 8% respectively, they are saying selling price will increase. How much? It will increase by 10% and variable cost will increase by 8%. By how much must sales volume change compared with the original budgeted level in order to achieve the original budgeted profit for the period? This is a very interesting question. See, the point here is they thought this will be the scenario, but apparently that isn't the case. We will plan for various things, but reality will be different. Here also the same thing has happened. Now what exactly has happened? Due to some changes in the market, variable cost is now expected to increase. Fine. But if it increases, then they will not be able to achieve the budgeted profit, which will go against their proposal. So therefore what they're asking us to find out is how much the sales volume should change, how much extra should we sell or less should we sell to make sure that the original budgeted profit remains the same. So for that to happen, we have to find out the original budgeted profit, and then we'll have to see how much should we change so that the profit remains the same. It's not a difficult problem, it's mostly a math related problem. Let us see how to work it out. Let me just first of all write down what is the existing data. So now according to the existing data, we have sales per unit is 28, variable cost is 16 and the fixed cost is 4. Okay. Let me just jot down the same thing again. This is nothing but the existing data. Okay. According to existing data, sales is how much? Let me write down the per unit thing here. Sales per unit is 28. That means we are charging 28 rupees per unit sold. Likewise, how many units are we proposing to sell? Right now we are proposing to sell 25,000 units. It's mentioned here in the problem. So what I will do is I will write down 25,000 units. Okay. So if I sell 25,000 units at the rate of 28 per unit, what would be my revenue? So 28, that is selling price per unit, multiplied by number of units which we are selling, which is 25,000, will give us 7 lakh rupees. That means my revenue based on the proposed budget will be 7 lakh rupees. Now coming back, we have variable cost. We cannot just look at revenue and be happy because there are costs involved as well. So let me deduct the variable cost and other costs and find out how much is the profit. Okay, because ultimately at the end of the day, what we are supposed to find out here is we have to retain the profit in spite of increase in the variable cost, in spite of increase in the selling price. The profit should remain the same, but the number of units sold may change. That is the thing. We do not know by how much the number of units sold will change. So now let me write down whatever is given right now, less variable cost. How much is the variable cost according to the problem? It is right now 16 per unit and fixed cost is 4. 16 per unit. So if I sell 16, or rather if I produce 25,000 units at the rate of 16 per unit, so this my variable cost will come to 4 lakh rupees. Likewise, my fixed cost should also be deducted. My fixed cost in this case was 4 rupees, right? 4 into 25 we know is 1 lakh, so deduct that too. Whatever is left will be my profit. 7 minus 4 minus 1, it's nothing but 2 lakhs. 7 minus 5 lakhs, 2 lakhs. This is my existing profit. This is easily done. But what is asked is, what will happen if it changes? So what should change here? Let's go back to the question. Now they say, due to market changes, both the selling price and the variable cost are expected to increase above the budgeted level in the next period. How much? Selling price will increase by 10%, whereas the variable cost will increase by 8%. We'll have to increase both now. Okay, let's do that. So let me just rewrite, let me call it revision. Okay, so sales will increase by, they said, 10%. Right now the sale value is 28 per unit. 10% of 28 would be 2.8. I'm directly writing this. I'm sure you know the math. 28 into 10% will be 2.8. So add that. 28 plus 2.8 will be 30.8. That will be my new selling price, because they have very specifically mentioned selling price will increase by 10%. Done. Now, what about the variable cost? Variable cost, they say, will increase by 8%. Okay. Minus variable cost. So right now the variable cost is 16. So how much is 8% of 16? We'll have to do the math. 16 into 8%, it will be 1.28. That means my variable cost will increase by 1.28 rupees. So add that 1.28. So this will become 17.28. Okay. So that means my sale price has increased from 28 to 30.8 and variable cost has increased from 16 to 17.28. That is also fine. Next, fixed cost remains fixed. So there is no change there. That will be 4 or 1 lakh. Okay. Now the point here is the profit should remain the same. Let's say my profit here is 2 lakh. Okay. And how many units should we sell to get the same profit? That we do not know. We'll have to find it out. Okay. So let us look at it now. For now, I will call it X units, because we do not know the number of units we have to sell to make the same profit even at increased selling price and increased variable cost. But what we know for sure is the fixed cost. The fixed cost is 1 lakh. It won't change. So 1 lakh remains the same. But the variable cost will be, and the sale price will be 30.8 into number of units. In the previous case, we could simply do it by multiplying that by 25,000 because we knew how much would be sold. But now we'll have to find out that. So that's why until we find it out, I have considered that as X. So 30.8 into X will be 30.8x. I'm just multiplying by number of units. According to me, right now it is X units. So just multiplied by X. Then 17.28 into X will be 17.28x. This has to be deducted. So if I have to look at it from the beginning, so if you see here, what is that we have got? 30.8x minus 17.28x minus 1 lakh rupees equals 2 lakh rupees. This 2 lakh being the profit. Now if I have to write this in the form of equation, how would it look? Let me do that. That would be, let's just go back to that equation, 30.8 minus 17.28. So 30.8 minus 17.28, both x. Okay, this is the thing. Then minus 1 lakh equals 2 lakhs of profit. What I have done is I have written the same thing in the form of a equation. We know for a fact that 30.8 minus 17.28, how much would that be? Let me just calculate. 30.8 minus 17.28. So that is 13.52. Okay. So 13.52x minus 1 lakh equals 2 lakhs. So this minus, if you take it to RHS, it will become positive, obviously. So 13.52x equals 3 lakhs. 2 plus 1, 3. Now it's easy to find out x. It's just elementary. X would be 3 lakhs divided by 13.52. 3 lakhs divided by 13.52 would be 22,189 units. Excuse me. So now what I have done is, even though it's fractions, we can't have fractions in units, so therefore I have just rounded it off. Okay. So what does this 22,189 units tell us? It only tells us that even with increased selling price and increased variable cost, if we want to achieve the same budgeted profit of 2 lakhs, we have to decrease our production. Or rather, yeah, we have to decrease the units sold. In this case, by how much? 25,000 was the existing minus 22,189. So 25,000 minus 22,189. So we have to sell 2,811 units less to achieve the same amount of profit. That's the thing. So that is exactly what was asked in the beginning. So by how much the sales volume should change. If you want, you can even find out the percentage here. Since they have asked about the change in the sales volume, we can simply do this 2811 divided by the original sales 25,000 into 100. Okay, Pawan here is asking which chapter is this. Pawan, this is budgetary control in management accounting part before ratio analysis. Okay, it's also the title of the video, by the way. I think so. Yeah, budgetary control. Now 2811 by 25,000. This is the change. This is the original unit sold. If you do the math, you will get the percentage. Divided by 25,000 as a percentage, if you find out, it will be 11.24. This is the decrease in the production for us to achieve the same level of profit. Again, not a difficult problem at all. It's purely based on common sense. There is no formula involved here. There is no accounting principle involved here. It's just basic arithmetic. So they have given some data. Based on that data, we have to find out the profit first, existing. Then they have also given data for the revision. Revision would be in case of only variable cost and selling price. Selling price increases, variable cost also increases. Then what is that we are supposed to do? We have to make sure that the profit remains the same, and then we have to identify, if the profit has to remain the same, how much should the sales change by? The sales has to change by 11.24% for the profit to remain the same. That is the thing. Okay, let's move on to the next question. Now in this case, they say PG Limited makes a single product, okay, and is preparing its material usage budget for the next year. Fine, they are worried about the usage. Each unit of product requires 2 kgs of material, okay, and 5,000 units of products are to be produced next year. One unit requires 2 kg and they need to manufacture how many units? 5,000 units. Okay. Opening stock of material is budgeted to be 800 kg. Fine. And the PG Limited budgeted to increase material stock at the end of the next year by 20%. That means they're talking about the closing stock here. This is the closing stock part. The material usage budget for the next year is, okay, what they're asking us is how much material will we use for the next year. This is easy to calculate actually. So they say each unit of product requires 2 kg. If it is 2 kg and if they are producing 5000 units, how many kgs of material would we require? That's easy, no? There is nothing much happening actually here. I can just solve it here itself. So 5000 is the number of units which we are proposing to produce, and the per unit usage of material will be 2 kg. If that is the case, 5000 into 2 kg, then 10,000 kgs. That's all. There is nothing much to do. But this is still a confusing thing, because in the exam, when you're actually looking at different questions, this is an MCQ type of exam. When you look at all the other data, the problem is, okay, just a second guys. Challa Janardhan asks, is this applicable for CMA students also? This is part of CMA, no? This is part of your syllabus, and this is from the budgetary controls chapter. Let me just show the chapter itself. Where is this now? See, this is the thing. Lesson number 15. Budgeting and budgetary control. This is lesson number 15 in your syllabus. So this is from the management accounting part. I hope it clarifies. So we are in this chapter. So even though it looks like a theory based chapter, there are possibilities of asking questions for MCQs, and in fact I would say some tricky questions may come from this chapter as well, like the one which we just now solved. It looks very easy, and it is easy, as we saw here. There was nothing much to do, but the problem is, in the exam you may think that the data which is given here might be useful. You may think that this data is also required for us to solve the problem, when in fact it is not at all required. That data is just given to confuse you. So we should be careful not to get confused by that. That's all. I hope it is clear. Let's move on to the next problem. Okay. For a department, the standard overhead rate is 2.5 per hour. Fine. They have given the standard overhead rate. Sometimes they will ask us to calculate this, but in this question they have already given that. Fine. Let it be. The overhead allowances are as follows. Fine. Let us look at the different types of allowances, or rather different levels of allowances. So activity level we have 3,000, 7,000 and 11,000. Fine. So if you produce at 3,000, the budgeted overhead allowance will be 10,000. That means you will spend so much. If you produce at the level of 7,000 hours, you will spend how much? 18,000. And if you produce at 11,000, you will spend 26,000. So that means they are given the change from 3,000 to 7,000. If you move from that level to next level, the budgeted overhead allowance will also increase from 10,000 to 18,000. And if you move from 7,000 to 11,000, the budgeted overhead allowance will increase from 18,000 to 26,000. So this again is easy to do, because here we have a specific formula and we can easily calculate what is what. Now let us look at the question. Calculate the normal capacity level on the basis of which the standard overheads rate has been worked out. Fine. Let's do this. It is not difficult, but it may be time consuming. So let us try to understand what is there in this. So now what is given? They have given, let me go back to the question, the various activity levels. One is 3,000, 7,000, 11,000. Just remember that. Then the budgeted allowance is also given. Just let me write it there itself so that I won't forget. 3, 7, 11. Okay. So then 10, 18, 26. 10, 18, 26. These are the hours, and this is the amount which they will spend if they produce at that level. So this is this. This is this. Now, variable cost per hour is not given. It's not at all given, but we require that to find out what. So to find out the question, whatever is asked. For example, in this case, they have asked this in normal capacity. For us to find out normal capacity, we need the variable cost. We do not have the variable cost, so first we'll have to find out the variable cost. Okay, so let us find out the variable cost in this. For us to find out the variable cost, we need to find out what exactly is the change happening with respect to cost and hours. So there is an easy formula actually. Variable cost per hour is nothing but delta cost divided by delta hours. Delta cost only means change in cost. Delta hours only means change in the number of hours. So if you take these two as examples here, if I have to extrapolate the same thing here, then what we can do is 10,000, sorry, that is the cost, right? So let me write down the highest first. 18,000 minus 10,000. Change is nothing but new value minus the old value. New value is 18,000, old value was 13,000. Sorry, 10,000. Same thing with the cost as well. Why am I saying cost again? Hours. So in case of hours, the new value is 7,000, old value was 3,000. So now we have delta cost over delta hours. We have done the same thing here. Difference in cost by difference in hours. So if you simplify this, this will be 8,000 divided by 4,000. So 8 by 4 is simple. It is nothing but 2 per hour. So now what is this 2 per hour? This is nothing but variable. Sorry about that. Where were we? This 2 per hour is nothing but variable cost per hour. So now with this variable cost per hour, we will try to find out different things. Okay. So now that we know what is what, we can easily calculate the total cost. Let us try to identify that first. Let me start a new page here. Total cost is nothing but variable plus fixed. Now we know variable. With the help of that, we can identify fixed cost easily. Let us see how. First of all, let me write down the activity levels. Which are the activity levels at which they wish to produce? 3,000, 7 and 11, right? Yeah. 3,000, 7,000 and 11,000. And what are the variable costs at those levels? That is also already given, 10, 18 and, oh sorry, that we have to find out, no? Yeah. There is only budgeted overhead. We found out just now. How much was that? 2 per hour. So these are the hours. So if you multiply hours into variable cost per unit, you will get the variable cost. So 3,000 into 2 per hour would be 6,000 rupees. That is the variable cost. 7,000 hours into 2 per hour would be 14,000 rupees. Next, 11,000 hours into 2 per hour would be 22,000 rupees. This is the variable cost. At the same time, we also have something given in the problem, which is the budgeted overhead allowance. That is the total cost which we are supposed to consider. So let's go back to the solution. Here I will write down total budgeted allowance. Here it only refers to total budgeted cost. At 3,000 level, we have the cost at 10,000. Next 18, after that 26. 10,000, 18,000 rupees and 26,000 rupees. Now we know the variable cost. We also know the total cost. What is that we need to identify here? Only thing which is missing here would be the fixed cost. So that will be the difference here. The balancing figure basically. So 10,000 minus 6,000, that will be 4,000. And you don't even have to worry about the next two units, increase in units, because it will anyway be same thing. So 4,000 once again and 4,000. I hope it is clear. So now what did we do? Through the variable cost per unit, we found out the fixed cost. Fixed cost is 4,000 rupees. Now, are we done with the problem? Unfortunately, no. We are yet to find out something else. Okay. So let me go back to the problem and see what exactly is asked. They have asked us to calculate the normal capacity level on the basis of which the standard overhead rates has been worked out. Okay. Let me just go back here and write down overhead rate is nothing but total cost divided by hours. That's the thing. So now this has already been given in the question. How much is this? Where is this? In the very first line they have mentioned. What is the standard overhead rate? 2.5. If that is given, how do we find out the normal capacity? That is easily done. We have to just substitute the values here. Let me just add a page. Once again, I am writing the formula. Overhead rate, which is actually given in the problem, is nothing but total cost divided by number of hours. Okay. So now overhead rate we just now saw is nothing but 2.5. If 2.5 is given, how do we find out the number of hours? Very easily done. Total cost we know is nothing but fixed cost plus variable cost. I don't have to write down 10,000, 18,000 or 26,000, but instead I will simply split that. How do I split total cost? Fixed cost plus variable cost divided by hours. We do not know what is the normal capacity, that is the hours. So I will simply write it as X, since that is the unknown variable. So now if I take this X to the LHS, it will be 2.5X equals fixed cost we know from the table is 4,000. So write 4,000 here, plus variable cost is very easily done. Variable cost is nothing but cost per unit multiplied by number of hours, X hours. So cost per unit has already been identified elsewhere. If you look at this, variable cost per unit is 2 rupees. So therefore, based on that, 2.5x equals 4,000, which is the fixed cost, plus cost per unit is 2 rupees, rupees 2, into number of hours, which is x. If I further simplify, let me just write down here itself, 2.5x equals 4,000 plus 2x. So let me bring 2x to the LHS. It will be 2.5x minus 2x equals 4,000. So if I further simplify, it will be 0.5x equals 4,000 and x equals 4,000 divided by 0.5, which is nothing but 8,000, half basically. 8,000 hours. That is the thing. So for us to identify this much, we have to take different routes. Once again, let me explain. For a department, the standard overhead rate is 2.5 per hour. The allowances are as follows. Activity levels were given. Budgeted total cost was given. What was asked was normal capacity. For us to find out that, first of all, we had to find out the variable cost per unit. On top of that, we had to find out the number of fixed cost, and then we could split the fixed cost and variable cost based on whatever we had found out till then, and finally we arrived at the normal capacity. So kind of a roundabout problem, but we have covered so many different elements in one single problem here. So if you understand this one problem, there are so many things which you will also understand. Maybe a component of this might be asked in the final exam. You never know. So that is the thing with respect to this problem. Okay. Hello to everyone who are live. Ankit Prajapati, Ayush Joshi, Oh my goodness, Ash Joshi is continuously saying hi. Hi, Ash Joshi. Fine. Let's see. What else? Okay, there is this small topic of activity ratios. I'll just give you a brief introduction of this and then we'll wind up the session. Now, what are these activity ratios? This again is a part of budgetary control chapter. This is also, this can also be asked easily for 1 mark. Very easy to ask as well. There's nothing much happening here though. It's very easy. Let's see. An activity ratio is a type of financial metric that indicates how efficiently a company is using or leveraging the assets on its balance sheet, of course, to generate revenues and cash. Once again, what is this activity ratio? It is nothing but a financial metric. That means financial measure. What do we measure? We measure through the activity ratio how efficiently a company is using or leveraging the assets in its balance sheet to generate revenue and cash. How are we making use of our existing assets to make sure that our revenue is up or to increase our revenue? That is what activity ratio measures. Okay. Thank you, Challa Janardhan. I'm glad you found it useful. So then that is about activity ratio. Then there is one more ratio. In fact, there are 2 more ratios. Capacity ratio. Now, what is this capacity ratio? It defines to show the capacity. As the name itself says capacity, it talks about the how much capacity we are utilizing. That's all. It is a comparison of number of working days in the budgeted period. Let's assume for a second that according to my budgeted period, my working days will be 220 working days. And if the actual working days was 230, let's assume, then we are actually operating above 100% capacity. Once again, what is this ratio called? Capacity ratio. What will this tell us? To what extent we are using our capacity. What is this capacity now? For a second, assume that our actual or rather our budgeted working days, we think in the next 1 year will work for 220 days. But it turns out that you actually work for 230 days. That means what? Even though you thought you will work for 220, you work for more than 220. That means you are working far more than your expected capacity. That means your ratio is above 100%. Whereas if it was the other way around, assuming if you thought that you would work for 230 and you instead only work for 220, it would be less than the capacity. That means you are working less than 100% capacity. So that is the capacity utilization. Okay, Challa is asking, can I take the marginal costing class? Why not? I think we can do this. Since you have requested, whenever I do the next live session of CMA, we'll solve few problems based on marginal costing. Okay. Thank you for the suggestion. So now, next, the efficiency ratio that is also given anyway. So that is the third ratio. The efficiency ratio measures whether the production output for a period in a production cost center took more or less the direct labor time than expected. This is again closely related to capacity but slightly different. So as they say, what are we measuring here? Again, it's also a financial metric which is measuring stuff. What is it measuring here? It is measuring the production output for a period in a production cost center. That's fine. Whether it took more or less the direct labor time than expected. I thought whatever I have produced so far, or rather let's say 5,000 units is the budgeted production. And I am thinking for those 5,000 units, I need 1,000 hours. Now, how will I know whether I am efficient or not? I will just calculate the efficiency ratio. How to calculate the efficiency ratio? Very simple. Check how much you actually used. How much labor hours did you actually use? Did you use 900 hours? Then you are definitely efficient. If you used 1,200 hours more than what you thought you would require to produce 5,000 units, then you are not efficient. So, which ratio tells us this? The efficiency ratio tells us this. Of course, there are formulas as well. You can look at the formulas. Activity ratio has a formula, efficiency ratio has a formula, and capacity ratio. All this is based on what? Standard, budgeted, and actual hours. For activity ratio, we have a formula which says standard hours by budgeted hours expressed in percentage. For efficiency ratio, it is standard hours by actual hours, again expressed in percentage. And lastly, capacity ratio, which is also expressed in percentage, is actual hours by budgeted hours. How do we remember this formula? You'll have to, there is no other go. You may get any of these questions in the exam. If you want to answer, you'll have to remember this formula. You'll have to by heart the formula. Activity, standard by budgeted. Efficiency, standard by actual. Capacity, actual by budgeted. So that is the thing. I think we'll wind up this session for now. I hope whatever we did was useful. In the next CMA session, we'll most likely take up the marginal costing, since that came as a suggestion by our subscriber Challa Janardhan. So if at all you have any doubts with respect to whatever we have discussed, you can leave a comment below. Once the live session ends, I'll try to get back to you. And if at all you have any suggestions for any of the topics which can be covered as part of our live classes on YouTube, please do suggest. We'll try to take it up. We have less than a month's time now for exam. Not more than a month, obviously. By next month, this time, I think your exams would have started, or maybe a few days would be there. So thank you guys. All the best. Study well.